A steady flow of income into your bank or broker account through a dividend strategy. Who doesn't dream of it? But is it that easy to build up a passive income? What are the advantages or disadvantages? Or can you even buy the stocks before the ex-dividend date and then sell the shares right after? Hi folks, and welcome back to my channel. I'm Björn, for those who don't know me, and nice to meet you. And if you are new, consider subscribing, as the community loves to have you here. So, for today's video, I'll take a closer look at the dividend itself and the best dividend strategies. I'll show you some of the misconceptions that dividend investors are making or saying, and when a dividend strategy actually makes sense for you, and how successful dividends have been in the past. So let's start. What are actually dividend? The return, so the percentage return that you can achieve by investing in stocks, consists of two components. First one, the increase of the price. If you succeed, you can sell a share for a higher price, the share price, than you bought it, right? The second, the dividend. Let's take a closer look at this one. The dividend is a distribution made by a company, usually paid out of its profits. In some cases, more than the profit of the company is distributed, but this is rather the exception and is not considered sustainable. However, it is important to note that the dividend can fluctuate greatly from year to year. If you value it, you should definitely look at the dividend history over several years. The most important metric that interests us in the connection with the dividend is the dividend yield. So, what is the dividend yield? The dividend yield indicates how high the distribution is in relation to the share price. The higher it is, the higher the payout that you will get as a percentage of your money. Let's have a look at Coca-Cola as an example. Coca-Cola made a profit of approximately 33 billion in 2020. If we downgrade that to a single share, we get earnings of $1.79 per share. The dividend yield is calculated here from the dividend per share divided by the share price and multiplied by 100. Since the share was quoted at a price of $45.68 in the year 2020, the dividend yield based on 2020 was about approx between 3 and 3.5%. Now, before we look at what exactly a dividend strategy looks like, I want to clear up 3 major misconceptions that are still floating around in the stock market. First one, even if it were nice, there is no free giveaway of money, believe it or not. Not even with the dividends. The reason, the so-called dividend discount, as a result, as soon as the dividend is distributed or paid to the investors, the share price falls by the amount distributed. And now let's have a look at another example. We have 2 identical stocks that are trading at $100 each. Both stocks have made profit over the year. Share A decides to distribute a part of the profit, more precisely 3% of the share price, to the shareholders. Share B reinvests the entire profit. The share price of the share B thus remains $100, as the profits have already been made and will remain in the company. The share price of share A falls after the distribution or for other reasons as well and distributed $3. So it's now at 97, right? Since there is now less money in the company A than in the company B, it must be worth less, which is what the stock price reflects. For the investor, it did not matter in which share he invested. With share B, he would have a share worth of $100 in his depot. With share A, he would have received a share worth of $97 in the depot and a distribution of $3, which is $100. So it's the same. If that weren't the case, you could just buy the stocks at the day before the annual general meeting at which the dividends are set and allocated, then collect the dividend a few days later and then sell it again. But the stock market is obviously not that stupid, right? Second reason, a big difference to a classic interest rate investment is the time component of the payment. The dividend yield is always based on the last amount paid out, hence a past-oriented key figure. The interest rate that you get on a bond, for example, is the promise for the future. So it can happen at any time that the company's dividend is increased, decreased, or in extreme cases are even completely cancelled, like we saw in 2020 while the corona crisis. In contrast to the interest rate, a dividend is not a value set in stone, but fluctuates every year and is therefore associated with a certain uncertainty for the future. Right? Third, dividend stocks aren't just safe businesses. In fact, dividend stocks often come from more defensive and cyclical industries. At the same time, however, many dividend investors assume that a high dividend promise a high level of security. But this is not the case, because many companies that have high dividend yields experience it because of the drop in their share price due to pessimistic market expectations. Current examples are Heinz, Makerich, Wells Fargo, and so on. So, now that I have dispelled the biggest misconceptions, we come to the criteria: what does a dividend strategy looks like? So, but what the heck is a dividend strategy? A dividend strategy describes a strategy for selecting stocks that focuses on stocks with particularly high payout in relation to the stock price. Basically, there are no limits to your freedom when designing the dividend strategy if they are related to the dividend, and everyone can define their strategy as they want. Nevertheless, there are some central factors that originally go back to the legendary Benjamin Graham and Michael B. O'Higgins, and among others. A popular dividend strategy is the Dogs of Dow strategy from that very O'Higgins. It is very simple though. You simply select the stocks that have the highest dividend yield and check this year for year and swap the stocks accordingly. And then basically you're done. That is the first dividend strategy. The famous rating agency Standard & Poor's, for example, has launched an index called S&P 500 Dividend Aristocrats. These include US stocks that have increased their dividends every year for the past 25 years. And these are just two of many different dividend strategies, right? But let's come now to the three big advantages of a dividend strategy. First, analytics shows stocks that increase their dividend and stocks that generally paid a dividend achieved higher returns and lower volatility than stocks that did not pay a dividend over the 42 years period. And Dividend Aristocrats, for example, has outperformed the S&P 500 since years. But be aware, not every dividend ETF or stock who pays dividends outperforms the S&P 500 or growth stocks who don't pay dividends. But more to that I will explain later on. The second, passive income with dividends, biggest advantage, and that's probably what we all want. You can generate passive income with dividends. A cash flow without you having to do anything for it. Here, however, I must make a restriction that I already addressed prior in the video. Because you could generate the same cash flow if instead of a dividend yield of, for example, 3%, you sell 3% of your portfolio every year. However, the dividend variant has one advantage. There are no transaction costs when distributing shares as when selling shares. So keep that in mind. So if you want to live from your investments, dividends are in case the cheaper option to see money from your investments in your account. Now probably you ask yourself, man, tell me how much I need to invest in order to live from it. No worries, later I will give you a small example of it. The third reason, however, is the psychological effect, an often overlooked advantage of dividend strategies. In fact, the greatest advantage, in my opinion, and cannot be found in the hard facts, but in the minds of investors, as some of the investors are afraid of making decisions. When it comes to dividends, you don't have to actively decide as you would with partial sales. As dividends are paid automatically in both cases, the result is exactly the same, but the emotions and the psyche that makes investors tend towards high dividend stocks triumph here. These factors are important because they can make you more relaxed, and the majority of investors fail not when the prices go up, but when the prices go down, and then panicking at the worst possible time. So, if a dividend strategy helps you relax and shift your focus away from the daily fluctuations in the stock market, that is a big plus. Now let's have a look at the disadvantages of a dividend strategy. First one, the cash flow. Yes, the cash flow is not only an advantage, it can also have disadvantages, depending on what you need the dividends for. One of them will outweigh you. First, if you don't need dividends to live on, but want to reinvest them directly anyway, the payout may just be an annoying intermediate step, as if the dividend had not been distributed. The company or the ETF could have continued to operate with it. That is not serious in the individual case. However, if you follow a dividend strategy for 30 years or more, you will put a lot of capital in your account without interest during these transition phases, depending on how quickly you reinvest your dividends. Second, you have both time and money involved in the transaction costs when you reinvest your dividend. Second, and for me the biggest negative point, you will have lower diversification and risk of losing good opportunities. If you focus on high dividend stocks, you will usually have fewer opportunities to diversify risk than usual, because there are some stock groups, usually smaller stocks or growth stocks, which prefer to reinvest their profits in the company itself in order to grow, which actually all investors want to see, right? Like take all the EV companies and disruptive innovation stocks. It's just as an example, but there are many more. Third point, higher costs. It is only when reinvesting the dividend that there are higher costs. You always have to pay your broker when you do so. But implementing a dividend strategy is usually associated with slightly higher costs as well. Fourth, the taxes. Every time when you sell a stock or you receive a payment on your broker account, you will have to pay taxes for it. Therefore, a tip from my side, it's another point to invest long term rather than in day trading. And now as a candy, some of the best dividend stocks for 2021 to buy or hold. First one, Procter & Gamble. The second one, Coca-Cola, Realty Income, Johnson & Johnson, Microsoft, Apple, and maybe even Line. But let me know in the comments in which dividend stocks you are invested, and if you know their dividend yield, let me know as well. And now let's come to the conclusion. A pancake has always two sides, right? So, dividends are not free money, nor are they simply a source of returns, as they are often presented. They can also be detrimental in terms of costs and taxes, depending on what you plan to do. Basically, you have to decide for yourself whether a dividend strategy works for you or not. And keep in mind that the dividend strategies can also increase in value through other strategies, such as value investing. And even if you don't use a dividend strategy today or don't need the associated payouts, as in my case, it can be particularly interesting in the future when it comes to enjoying your hopefully accumulated wealth. Then, An additional income in addition to a state pension can be very valuable and attractive. Therefore, my recommendation, if you are still young, go with growth. If you have already a big portfolio, normally when you are older, you can then go with dividend stocks and either live from it or reinvest. But now to the example I promised. If you want 2K to live each month of dividends, you will need to have roughly 600K on your depot, assuming a 4% dividend yield. So you see, it's not that easy. But before watching another video, let me know in the comments what you think about dividends and if you go for dividend stocks or ETFs, or if you prefer growth stocks or maybe both. That's it for today. Thanks for watching, and as always, stay focused and don't get greedy. See you all next time.